The mid-cap index is up about 70 odd points, so a flat opening.
It's been moving in a tight band of just about 0.4% at lower levels.
Look at that move. It has swiftly moved higher after a tepid opening that we saw early in the morning.
It's just 35 points away, and the clock is ticking. There's 60 minutes to go. It's a matter of time, right? I mean, so we'll have to wait, I guess, for a gap up tomorrow morning on the Nifty for the 20,000 mark. It's just like, I guess, an overnight session. The high today was made at 19,991.85. So just...
Hello and welcome to Markets Today, the show where we track about 6 hours of the day's trading action in just 5 headlines. I'm Ekta Batra here at the top stories for this evening. Stock markets rally in the last hour of trade. The Nifty is now within touching distance of the 20,000 mark. Sensex gains nearly 500 points. Infosys meets estimates in the first quarter but hands a sharp cut to its full-year growth outlook from 4 to 7% earlier to just 1 to 3.5%. FMCG giant HUL Q1 earnings is a mild miss. Net profit sees a growth of 8% year-on-year but falls short of estimates. Domestic volume growth misses street expectations as well. Reliance spins off its financial services business. Jio Financial is valued at about $20 billion as stock exchanges hold a special one-hour session for price discovery. Market values one share of Jio Financial at nearly 262 rupees, which is much higher than analyst estimates. ABB India slips, pulling down other cap goods stocks after its parent reports a dip in new global orders and over 7% order growth in India. But the narrative on India is positive and some analysts are sanguine given the high base. All right, well, straight to all the action from Dalal Street. A last hour rally saw the market scale new peaks for the second day in a row. The Sensex and the Nifty gained over 0.5%. Nifty is now only 20 points away from the 20,000 mark, while the Sensex broke above 65,700. Banks led the up move, with that index soaring over 1%. Mid-caps underperformed the blue chips. All sectoral indices ended the day higher except for the Nifty IT. In fact, the Nifty has gained 3,000 points since March of this year. Nigel D'Souza is here with the top gainers that led to this rally.
Well, the Nifty almost went to around the 20,000 odd mark but fell a little bit short. But that doesn't take away from the fact that the last 4 months, what a rally we have seen. From peak bearishness, we have moved to peak bullishness. The Nifty up more than 3,000 points, the Nifty Bank up more than 7,000 points, and in terms of total market capitalization, we have added more than 50 lakh crore rupees. Well, on the Nifty, these 3,000 points, well, they have primarily been contributed by big boy Reliance Industries, ITC, the two big banks in there, and even Bajaj Finance. So close to around 45% of the gains are on top on the back of these stocks itself. In absolute most, you're talking about frontline Nifty names that have given you big returns. Tata Motors, IndusInd Bank, you have HDFC Life, Bajaj Finance, as well as Mahindra & Mahindra. Well, they have gained more than 30% just in the last 4 months or so. Well, you'll say the Nifty has done quite well. 3,000 points, 17.5%. The real party has been in the mid-cap and the small-cap space. And that's the absolute index that it's moved up by around 24 to around 27%. But individual names, they have moved very, very well. Frontline names, if people who are throwing in the towel on Oro Pharma has given you more than 60% returns. Polycap, stellar numbers, that stock is up close to around 60%. And L&T Finance as well as Paytm, that's up more than 50%. But the list doesn't end there. You have a few more names that should come up for you on the screen. Patanjali Foods, PFC, IDFC First Bank, as well as Piramal Enterprises. All these names are up by close to around 50%. It doesn't end there. If you look at the small cap names, well, they've given you even better returns. You're not satisfied with 50, 60% returns. Mazagon Dock, Suzlon, RVNL, Tanla, as well as BSC, all of them up more than 70%. And let's wind this down with a few more gainers from the small cap space that have given you big returns of more than 50%. Short point, last 4 months, what a rally we have seen. The Nifty up more than 3,000 points, market capitalization up more than 50 lakh crore rupees, telling you that the bulls, well, they have been charging ahead.
All right, definitely, Nigel, the bulls are in charge. But in market opinion, then, Ashwini Agarwal, founder and partner at Demeter Advisors, believes that valuations in the mid and small cap space are quite reasonable. He also adds that he would stay out of the IT space.
In the whole mid and small cap space, where I think the valuations are still quite reasonable. So, mid and small continue to be very attractive, notwithstanding the kind of outperformance that we've seen over the last 1 quarter. I've been quite flummoxed by the kind of strength that we've seen in the IT names, especially after the disappointments from all the majors. I was sniffing at this sector, as I'd mentioned in our earlier conversations, between April and June, but decided to stay away, thinking that the June results might offer an opportunity because I expected them to be weak. I was hoping to purchase IT large caps into the correction that I had expected post the results, but that hasn't happened, so I'll stay out for now.
All right, on to the second headline now. Infosys met street estimates in the first quarter, but handed a sharp cut to its full-year growth outlook from 4 to 7% earlier to just 1 to 3.5%. Reema's here with the key highlights.
Thanks so much for that. As you pointed out, despite an in-line steady first quarter, Infosys has gone ahead and sharply revised its top-line guidance. Earlier, they were anticipating that in FY24, revenue growth will be between 4 to 7%. But in just 3 months, that top-line guidance has been revised lower to 1 to 3.5%. So that's a very sharp cut that we've seen. That said, Q1 numbers are in line. The company's clocked in a constant currency revenue growth of 1%, slightly ahead of consensus expectations and better than what peers had reported. Remember, for HCL and Wipro, constant currency revenues had declined. For TCS, it was absolutely flat. In contrast, at least Infy has seen a top-line growth of 1%. Margins are down 20 basis points to 20.8% versus 21%. Deal wins have picked up. Current quarter, they're at $2.3 billion. In the prior quarter, deal wins were at $2.1 billion. So deal wins is steady. The company's attrition has further eased down to 17.3%, and the net headcount continues to moderate. We've seen that with peers as well, but even for Infy, the net headcount, has come down by nearly 6,900 employees. But I think what's disappointed the street the most is that India's second largest IT company is actually going to see very, very feeble and meager growth in FY24, just 1 to 3.5%.
We've had a very strong Q1. Our Q1 growth was solid at 4.2% year-on-year, 1% Q-on-Q in constant currency. We had 20% growth in manufacturing, 13% in life sciences. Our European business grew by 10%. Our operating margin for the quarter was strong at 20.8%. Our large deals value for Q1 was at $2.3 billion. 56% of this was net new. This included one mega deal win. In the short term, we see some clients stopping or slowing down transformation programs and discretionary work. This is especially so in financial services, in mortgages, asset management, investment banking, and payments. And in telecom, we also see some impact in high-tech industry and in parts of retail. Even as we won 2 mega deals recently, we have a strong pipeline of large and mega deals. We see revenue from some of these and other large deals towards the later part of our financial year. Keeping that in mind, we are changing our revenue growth guidance for this financial year to growth of between 1% to 3.5% in constant currency.
All right, that's Infosys. But the third headline today, FMCG giant HUL's Q1 earnings was a mild miss. Net profit witnessed a growth of around 8% year-on-year, but fell short of estimates. Domestic volume growth missed expectations as well. Manglam is here with the key highlights.
Well, HUL's first quarter performance are a mild miss as against street expectations. The street was working with a revenue growth of 8.5%. The company reported a revenue growth of just around 7%, and that was led by underlying volume growth of 3%. A number that the street was working with was close to around 5 to 6%. As a result of which, the EBITDA was below expectations, and as were the net profits of the company. Importantly, there was an improvement in the gross margins, but a large part of that was reinvested back in ad spends, which are now at around 10% of sales. And that's something that the management spoke about as well, where they foresee gross margin expansion, but a large part of that will be reinvested into ad spends, largely because competitive intensity in the market, specifically in some geographies and the mass category, has increased. In terms of segments, the home care business grew about 10%, beauty and personal care grew by almost 5%, largely in line with street expectations. It was the foods business which grew by around 4.5%, and the volumes out there were flat, led by weakness in their Horlicks business as well as the ice cream business that was impacted by unseasonal rains. By and large, it is a bit of a miss, but going forward, management does expect some sort of gradual recovery. Expect the stock to see some red.
Okay, all right, Mangalam, thanks very much for that. So that's on HUL. But in more earnings, Havells was under pressure after reporting a miss on net profit for the first quarter. The company's net profit came in at over 280 crores versus an expectation of over 320 crores. Even margins came in much lower than estimates. However, Havells has reported a beat on the revenue front. Surbhi is here with the details.
Thanks so much for that. So Havells, it was a decent showing, the numbers were below expectations, but for cables and wires, the company has seen growth. Now the overall revenues were up 14% on a year-on-year basis. The gross profit margin also saw some expansion, came in at around 30%. The EBITDA was up 11%. Margins were a tad bit lower, came in at 8.3% versus 8.5%. The expectations were that it would reach the 10% mark, and the PAT was up 19%. Now when you look at the segmental reporting, cables, which is 30% of their revenues, there the revenues were up 24% and the margins came in at 11% versus 7%. The lighting segment, that showed some weakness, and that is similar to what Polycab also said. There is some pressure on the LED pricing, and that has played out. The revenue was down 1% and margins were lower by nearly 200 basis points. Lloyd, which is the second largest part of their revenues, there the revenues were up 20%, but the losses have expanded. So loss of 62 crores versus a loss of 56 crores. So they are probably gaining market share, but still not making profits in the Lloyd segment. And also unseasonal rain has impacted sales for the AC segment. So we'll have to watch out for some commentary on that as well. But overall, the consumer demand has been weak, and that is what the management has said in their press release. So that is also playing out as well.
Okay, all right, Surbhi, thanks very much for that. Staying with the broader markets, Hatsun Agro surged over 7% on the back of good operational performance in the first quarter. Net profit grew by over 50% on a yearly basis. Their gross margins improved while other expenses lowered. The chairman of the company says they continue to target double-digit growth for FY24. He also intends to reduce the company's debt.
The milk situation is improving this quarter, and I believe things will start improving. But again, commodity business may take little more time for us to get in. We may get into double-digit without any difficulty. But we are sure that this margin, whatever we are maintaining, it can only be better and not less. See, earlier probably Tamil Nadu used to be about 65% to 70% of our business. Last 4 years, gradually it has been coming down. And right now we can say that Tamil Nadu contributes 50% and the rest of the 50% comes from other states where we have entered earlier. Gradually the volumes are picking up. The next 2 years, my option could be it will be less than 500 crores debt. Because heavy depreciation is available, which is a cash inflow for us. And capacities are mostly built. So the debt could be in 2 years less than 500 crores in my opinion.
Okay, well, we also had Krishna Diagnostics, which tumbled over 14% after its LOA for Rajasthan got cancelled. So just to put it into perspective in terms of the news, the company had won the tender in March of 2023. The tender was to provide lab services under free diagnostics initiative under the National Health Mission. The company had the potential to generate around 450 crores of revenue over 3 years. They cancelled it due to certain disagreements over providing additional performance security. The company has said that they have taken legal recourse and there is no impact on the existing business. According to analysts, the tender had the potential to add around 150 crores to FY25 top line and 42 crores to the EBITDA. Plus, the instances of such cancellations could impact valuations, and there is fear that other tenders could also probably result in some kind of one-off tendencies. Well, that's the reason why Krishna Diagnostics was down around 14% Time for a short break now, but we'll be back with more headlines on the other side. Stay tuned. Where shares of Jio Financial Services, the demerged NBFC arm of Reliance Industries, has been pegged at around 261 rupees per share. This is based on the difference between the Reliance Industries stock price after the special 1-hour price discovery session and yesterday's closing price. Prashant Nair is here to give us details.
Well, so the demerger has happened and Jio Financial has been spun out of Reliance as a separate entity. Let's take a quick look at a few quick numbers. Now, Jio Financial Services demerged price was for Jio Financial Services was found at 261.85, which is, as you can see, based on subtracting the RIL price discovered in the pre-open session from yesterday's closing price. Now, Jio Financial Services potential market cap, right? The implied of the potential market cap of Jio Financial works out to 1.66 lakh crores. Basically, since the merger, the demerger ratio is 1:1, you just simply take the equity capital of Jio Financial Services, RIL x the treasury stock, 635.3 crore shares, multiply that with the discovered price, and you get the implied market cap, which is 1.66 lakh crore rupees. Now, this is what the market is implying, right? But the SOTP, based on what Jio Financial Services already has, also works out to not a very different number. And you can see the breakup really coming through here. Let's actually tell you, how I've broken this up. The reported net worth of Jio Financial is 28,100 crore rupees. From this, you subtract the cost of acquisition of this 6.1% stake in RIL. Right, the value of the stake is much bigger, but the cost of acquisition for Reliance or for Jio Financial is 17,000 crores. So the core net worth is 11,100 crore rupees. You can sort of lever that, give it a multiple of 3 times, and you're basically looking at a core book of 33,300 odd crores. Now there is the 6.1% stake, which you will value at the current share price of Reliance Industries. Now, taking RIL's market cap as 18 lakh crores, the 6.1% value works out to 1.1 lakh crore rupees. You basically add the, the 1.1 lakh crores and this number, the earlier number, 43,300, and you get the total number, which is 1.43 lakh crores. So, as you can see, there is not very much by way of a difference between what the market-derived value is and what the SOTP value is. You can change these numbers around. Instead of 3 times book, you can give it a 4 times book, and the numbers will change around. But as you even right now, there is not that much of a difference in terms of both these numbers. What next? As we've been saying, Jio Financial will remain part of the Nifty and the sensex and other indices at a fixed price of 261.85 till it actually lists. So it'll be the 51st stock on the Nifty, 31st stock on the sensex. Of course, not traded. The price is fixed. And then it will be removed from all indices post-listing, subject to conditions, etc. We don't, as of now, of course, have a listing date for Jio Financial Services. Back to you.
Okay. All right, Prashant. Thanks very much for that. As you can see, the disclaimer is on your screen. Reliance is the owner of the channel that you're watching. All right, well, let's move on to the fifth headline today. ABB India slipped nearly 7% after the parent company ABB Global reported a weak set of quarterly numbers. The order inflows also declined, but the narrative on India is positive and some analysts are sanguine. Given the high base, Vivek Iyer is here with the details.
Well, that's right. At the start of the trading session, ABB Global actually went ahead and declared its Q2 calendar year 2023 results. And within that, we are looking at the India read across and what exactly is causing the share price fall today. So number one, what they've said is that India's order inflow growth stood at 7% in the second quarter of the calendar year 2023. And this is from the investor presentation that ABB Global has uploaded onto their website. Now, one thing to note is that, ABB Global has actually both listed as well as unlisted businesses in India. So the actual ABB India order inflow could be slightly softer than the 7% number that is actually come in the investor PPT. Now, however, what ABB Global has said is that the India growth is actually a shining light, given the fact that there has been demand decline in China, and India actually has seen significant strength as far as ordering activity is concerned. Orders in Asia, Middle East and Africa declined by 3% against, the 7% growth that we're seeing in India. Now, apart from that, what we are looking at is that number one, India ordering activity is coming off a very, very high base. And also, going into this particular earnings season, the previews of Macquarie actually expected a flat growth as far as, the ordering activity was concerned. Against that backdrop, this particular number is not too bad. But despite that, the slowing pace of the order inflow growth is something that at this point of time is spooking these companies that trade at very lofty valuations.
Okay, all right, Vivek, thanks very much for that. Well, moving on, Dr. Reddy surged over 2% after the US FDA completed a pre-approval inspection of their Srikakulam API facility. It is important to note that this particular facility in 2015 was issued a warning letter. In 2020, it was re-inspected by the US FDA. It was issued 5 observations then. Eventually, it was issued a voluntary action indicated status in May of 2020. and then the warning letter was lifted in August of 2020, or they received a closeout letter. This time round, they were inspected by the US FDA, 0 observations, and the US FDA has indicated a no action indicated status, which means that this particular facility is in compliance and hence business as usual for Dr. Reddy's going forward. The stock is in any case very close to its 52-week high and has rallied significantly. The compliance is definitely a positive for the company. Well, shifting focus now to the mutual fund sector, asset management company stocks surged in early trade today after sources told CNBC-TV18 that SEBI was planning to float a new consultation paper on mutual fund expense ratio norms within a week. Remember, the industry had earlier requested for the removal of GST and securities transaction tax from the total expense ratio. Yash is here with the details.
Well, it all started with that June 20th SEBI board meeting where market regulators spoke about how they plan to bring a revised circular draft consultation paper on the TER or total expense ratio regulations for mutual fund industry. What got the industry most excited was the statement from SEBI chairperson, which essentially said that the new draft paper will sort of be beneficial for the mutual fund industry, and the industry will be very pleased looking at that. What we've been given to understand from our sources is that this new draft consultation paper on TER regulations for the mutual fund industry is expected within a week itself. Now, as the SEBI chairperson said, and what also we've been picking up is that this could have significant changes from the old draft consultation paper which was floated by market regulator SEBI. Now, TER is total expense ratio. What we've been given to understand is that the mutual fund industry has sought 2 important things. One is removal of securities transaction tax or STT and GST from the purview of TER or total expenses ratio. Also, they've asked that TER should be calculated or continue to be calculated at a scheme level and not at an AMC level. We need to see, as far as this new draft is concerned, which is expected, how much change does it bring to that old consultation paper, as SEBI has said that it will involve significant changes. That remains awaited by the mutual fund industry.
Okay, all right, Yash, thanks very much for that. With that, it's a wrap on this edition of Markets Today. Thanks very much for watching.